Hello and thanks for tuning in. The objective today is to present IBISWorld's commercial banking service capabilities for the functional areas of risk mitigation and credit portfolio management. This presentation is intended for our new commercial banking clients or IBISWorld clients that are interested in further leveraging their service contract. Prospective clients should also find this useful in understanding the best practices employed by our long-time banking clientele. Note that all the capabilities discussed below incorporated input from the banking community, often involving steering committees. The tools we've co-designed with clients are actionable and easy to implement. The processes discussed here are transparent and follow current regulatory requirements. Feel free to circulate this documentation to others within your organisation and let us know if you require further information. We'd be happy to arrange a conference call at your convenience. Credit risk executives and portfolio managers begin by using our website, in particular following the Credit Risk tab in My IBISWorld for Banking. Here, clients access IBISWorld's industry reports and risk ratings, as well as our segment benchmarking, financial ratio, and state and county level data. Many have found our Data Wizard a convenient way to locate and download unique data that can be easily incorporated within their workflows. So, what are the next steps typically taken by risk and credit portfolio managers? It's basically a stepwise process with the support of senior IBISWorld staff. After incorporating key information for our industry risk reports and risk ratings into their workflows, clients continue down a sequential path at their own pace. There are basically 4 steps in this sequence. First, clients download and integrate the data from our industry early warning system into their systems. In turn, many employ the structure and data found in IBISWorld's supply chain and concentration risk tools. This helps clients construct customer relationship management and credit risk management dashboards. Incidentally, there is a rapidly growing trend to automate the process via API. As we'll see later, the ultimate goal of many banks is either building or upgrading their bank's risk and portfolio management systems while incorporating new, unique data sources that are easy to understand and deploy. Let's take these items one by one to give you a better idea of how they fit together and why they're so important. Prior to detailing this stepwise procedure, a brief review of the methodology underpinning IBISWorld's industry risk ratings should prove useful. Developed more than 20 years ago with a commercial bank steering committee, the forward-looking risk ratings are available for 700 NAICS-based industries and are updated monthly. They are composed of key structural factors based in large part by Michael Porter's 5 forces. Elements like barriers to entry, the degree of competition, the life cycle stage of an industry, as well as an industry's revenue growth prospects are included. Key external factors are also used to calculate risk scores. These include macroeconomic variables like interest rates, GDP components, and commodity prices, as well as demographic data. We also consider forces that resonate along the supply chain, basically the pricing power of both an industry's suppliers and the markets where its products are sold. Details of the methodology are available upon request. As we'll see later, banks employ our risk scores and other IBISWorld risk metrics as key risk indicators, integrating them with their internal data, so-called key performance indicators. The methodology is consistent with regulatory guidance, particularly those regarding concentration risk, and is a critical element in the process of utilizing IBISWorld tools. The most popular IBISWorld tool used by hundreds of risk and portfolio management professionals is our industry early warning system. The downloadable Excel workbook houses our forward-looking risk ratings and 20 other unique risk metrics. We recently updated the system to include metrics on company exit rates and liquidity risk. The workbook contains NAICS mapping tables and mappings to the OCC taxonomy. The OCC hierarchy often serves as a guidance to define a bank's lines of business. Let us know if you'd like to peruse the early warning system technical documentation. It defines each metric and also provides some bank best practice tips on how each variable is typically applied. Next, let's consider IBISWorld's supply chain and concentration risk tools. These are used sequentially, building on the implementation of the early warning system. Like the early warning system, data is delivered as a workbook with NAICS mapping tables. The first of two concentration risk databases includes supply chain data for each of the 700 industries for which IBISWorld compiles risk ratings. This workbook provides a NAICS coded list of the top supplier or upstream industries and buyer or downstream industries, again for each of the 700 NAICS-based industries we analyze. As you'll soon see, this data and its structure are useful in identifying both a bank's direct and indirect loan exposures. Another popular IBISWorld tool is our Macro Drivers Workbook that contains data not unlike the Fed's CCAR macroeconomic variable list. It includes the top 40 macroeconomic drivers and identifies which NAICS industries are most impacted by the driver in question. Here's a sampling of the kind of driver data available in the tool. By the way, more advanced clients have used this tool to stress test or run scenarios to identify which of their lines of business are vulnerable to a specific shock. For example, consider which segments of a portfolio are threatened by unforeseen interest rate movements. Data for both the supply chain and macro drivers is easily accessed by clients using IBISWorld's data wizard that's available on our website. This is often a prelude to more automated data delivery methods employing API, as we'll discuss later. It's time to provide some illustrative examples on how our commercial banking clients apply our proprietary risk-related data and workbook tools to address the many challenges of risk mitigation, lending policy, and fundamental portfolio management. Let's begin by explaining how banks connect their performance data with IBISWorld's data. Use the NAICS mapping tables that are embedded in all our portfolio management databases and tools as depicted here. Using mapping tables, here's how clients identify both direct and indirect loan exposures. Consider hotels and motels having a NAICS code of 721110. Using this code, a client can identify their outstanding loan balance, which for this hypothetical bank is 18.5 million. If the bank's data is granular enough, they can segregate the data into both outstanding balances and lines of credit. But that's not all. Utilizing our supply chain workbook, a bank can identify upstream and downstream industries where they have significant indirect exposures. In this example, again using NAICS codes, this bank has an additional upstream exposure of 14.1 million in restaurant and hotel equipment wholesaling, plus an added downstream loan balance of 13.3 million in travel agencies. So, in this example, the total loan balance is 45.9 million, almost half of which is indirect, not an uncommon result. This illustrates how our banking colleagues identify, quantify, and manage concentration risk. This application has often helped resolve regulatory MRAs, those dreaded matters requiring attention. Moreover, this process also shows how banks can uncover safe and sound lending opportunities in areas where they may have institutional knowledge and are underexposed. The next step commonly undertaken is to use the NAICS mapping tables to integrate IBISWorld's key risk indicators that are housed in our early warning system with a bank's internal data and their key performance indicators. It might look something like this. Let's summarize what we've done so far by considering the steps most of our client banks follow while integrating IBISWorld's early warning system metrics into their credit portfolio management processes. Clients typically have a commercial lending worksheet that has a similar format to the one seen here. The first column lists industry groups that represent lines of business. Here, significant subsegments are broken out from the aggregate LOBs. In this case, soybean farming is broken out as a separate entry in the agribusiness group owing to its relative importance to this hypothetical bank. The worksheet is populated by IBISWorld and other sourced key risk indicators in orange, plus a collection of the bank's historical key performance indicators in blue. This data obviously varies from bank to bank. The first task is to determine which IBISWorld risk metrics are appropriate. By the way, our senior commercial banking staff are available to assist as we've had years of experience working with banks of all sizes. Using IBISWorld's NAICS mapping tables, banks draw in a host of their internal performance data, combining it with risk indicators. This provides a comprehensive analytical view of the relative health of each line of business. The next task is assisting clients to define or refine their specific lines of business. We accomplish this with the aid of our own research on correlated industries and regulatory guidances on concentration risk. Policymakers and risk managers apply this framework in many ways, including the support of policy narratives like risk mitigation, pricing, setting limits, establishing capital requirements, and of course, targeting areas for growth. Other benefits include identifying and quantifying concentrations, driving scorecards and grading systems, and supporting stress testing and scenario analysis. Speaking of scorecards, here's an actual example of what a client put together as published in the RMA journal. Along with the obligor's financials, banks often use IBISWorld metrics to help assess credit worthiness. The highlighted data comes directly from IBISWorld's early warning system. That's supplemented with data from our supply chain workbook. Well, it's time to wrap things up. In the past 3 to 5 years, there's been a rapidly accelerating trend to achieve the final step, assisting clients who are building dashboards and automate the process we've discussed via API. IBISWorld is geared up for this, supporting banks as they engineer customer relationship management and credit risk management dashboards. With the bulk of our website data callable through API, our technical staff stands ready to provide workable solutions. Enabling you to integrate data within bank approval applications, connecting the dots between credit portfolio management and actual lending. Finally, here's what a client dashboard can look like, integrating IBISWorld data with yours, all facilitated by API. Thanks for joining us today. For further information or to discuss in more detail, please contact your IBISWorld representative or email us at commercial-banking@ibisworld.com.